Micron just dropped 6.1. Fin in a single session. Not on a scandal, not on a fraud allegation, but on something far more instructive. Here is the uncomfortable truth. In semiconductor stocks, the distance between a great business and a great stock is measured entirely in expectations. And today, that gap snapped shut. The question every serious investor needs to answer right now is not whether Micron's underlying AI demand thesis is intact. It probably is. But whether today's price reflects a genuine recalibration or a market overreaction that creates an entry window. That answer is not obvious. And anyone telling you it is selling something. Let's establish the facts before we do any interpretation. Micron is the only major US-based manufacturer of DRAM and NAND flash memory. That makes it a pure-play proxy for memory pricing cycles, which are notoriously volatile, and increasingly a direct beneficiary of AI infrastructure spending, specifically through high-bandwidth memory, or HBM, which is the premium memory stack that NVIDIA's H-series and Blackwell GPUs require at scale. So why the 6.1% drop? The proximate catalyst traces to a combination of forward guidance concern and macro signal deterioration. In mid-2026, the memory market is navigating a classic post-supercycle digestion phase. NAND pricing, which surged through late 2025 on data center restocking, has begun showing sequential softness in spot markets. Several downstream channel checks published by sell-side desks this week flagged weaker than expected PC and consumer electronics end demand, which compresses the commodity NAND segment that still accounts for a meaningful slice of Micron's revenue mix. Simultaneously, a macro data point released this morning, specifically a softer than expected ISM manufacturing print, reminded the market that enterprise CapEx is not immune to rate environment friction. When you combine a cyclical demand signal with a macro headwind signal on a stock trading at a premium multiple to its historical earnings average, you get institutional sellers hitting the exit simultaneously. Here is the actionable framing. Micron stock was pricing in near perfection on HBM growth. Any friction in the adjacent segments gets punished disproportionately because it introduces doubt about the full earnings trajectory. Today was not a verdict on the AI thesis. It was a multiple compression event triggered by margin of safety erosion. Those are very different things, and conflating them is the first mistake retail investors make. This is the question that actually matters, and it requires separating signal from noise with some rigor. First, the bear case for today's move being justified. Micron's forward price-to-earnings multiple entering today's session was elevated relative to where the stock has historically traded during mid-cycle memory conditions. When a cyclical company trades at a growth multiple, it is borrowing against future earnings certainty it has not yet delivered. The moment that certainty gets even slightly questioned by a soft macro print, a channel check, a competitor commentary, the market re-rates fast. That is not irrational. That is how cyclicals with premium multiples are supposed to behave. The 6% drop can be read as the market responsibly resetting the risk premium. Now the counter-argument, and this one is grounded in structural data. HBM revenue is a fundamentally different business than commodity NAND. The margins are higher, the supply chain is tighter, and demand is being pulled forward by hyperscaler AI CapEx commitments that are multi-year in nature. Micron has publicly confirmed HBM3E production ramp timelines, and their customer concentration in this segment includes the largest GPU buyers on the planet. That demand does not evaporate because ISM prints below 54. The intellectually honest read here is that today's move is partially justified and partially sentiment-driven. The stock deserved some multiple compression. but a 6% single-session decline on a name with confirmed AI infrastructure exposure and a duopoly-adjacent position in HBM supply has historically created medium-term entry points, not guaranteed ones, but statistically meaningful ones based on prior cycle behavior. Just to be clear, none of this is financial advice. What it is a framework for evaluating whether fear is driving price or fundamentals are. If you are newer to investing and you owned Micron today, there is a high probability you either panic, sold, into the drop, or convinced yourself to buy more using logic that sounds smart, but is actually dangerous. Let's address both. The panic sell impulse is triggered by loss aversion, the cognitive bias, where losing 6% feels twice as painful as gaining 6% feels good. Neuroscience confirms this is hardwired. The market knows it too. Institutional traders actively exploit retail stop-loss clusters during high-volume sell-offs in momentum names. When you sell a fundamentally intact business because it moved 6% in one session, you are not managing risk. You are transferring your shares to someone with a longer time horizon than you, at a discount. The opposite error is equally costly. The reflexive, buy the dip. Buying a 6% dip because you like the company is not a strategy. It is emotional anchoring to a prior price. The fact that Micron was at a higher price yesterday has zero informational content about where it should be tomorrow. What matters is whether the current price offers a margin of safety relative to a realistic earnings path. And that calculation requires knowing the HBM revenue trajectory, the NAND pricing cycle position, and the macro rate environment. If you cannot quantify those inputs, you are guessing, not investing. The beginner insight here is structural. Single-session volatility in a high-beta semiconductor stock is not an event. It is a feature. Micron has historically had an annualized volatility in the 40 to 50% range. A 6% day is noise inside that distribution. The investors who build wealth in names like this are the ones who had a thesis before the drop, stress, tested it during the drop, and made a disciplined decision, not a reactive one. Volatility is not your enemy. Reacting to volatility without a framework is. So here is where we land. Micron dropped 6.1% because a premium multiple met a softening macro signal, and the market compressed the risk premium fast, as it always does with cyclicals. The AI thesis is not broken. The multiple was stretched. Those two things can both be true simultaneously. Now the follow-up question, and this is what the next video addresses, is whether the broader semiconductor complex is entering a mid-cycle correction or something more structurally bearish. Subscribe so you do not miss that one.